Good morning, everybody, and thank you for joining us today in our federal budget wrap-up, our second federal budget for this year. So we were lucky enough to get one from the Liberal government back in late March on the proviso that they'd be back in office. Obviously, they aren't. So now we've got the first Labor government budget. What we're going to go through today, it's not a very in-depth budget, so we don't expect to go for too long. But what we'll go through are the measures that were announced, what measures are going to be kept from the previous budget, as well as anything that's been deferred or potentially delayed. So first thing I just want to go through is, who are we? So a majority of people on this are clients, but for those that aren't, my name is Shaun Farrugia. I'm the Director of Optimised Accounting. We're a Melbourne-based accounting firm who has the pleasure of working with small business owners. We've been in business for about 8 years, and we work with primarily service-based businesses with turnovers ranging from a couple $100,000 a year, all the way up to $45 and $50 million in a variety of industries, as well as services, property development, and builders are a niche that we also do cater to. What we're announcing today is basically everything that was spoken about 36 hours ago on Tuesday night. Before we get into anything, it's worth noting this is all general advice. We're talking to a wide audience with this. If you are after specific advice for your situation, please make sure that you do speak to your advisor. If that's us, please reach out. It's also worth noting that some of the topics today are actually not legislation yet. The budget, to some extent, is a bit of a marketing and a puff piece. Not that there was much puff in this last budget, but they are what the government intends to bring in, but whether or not it does, pass all the way through Senate is unsure. So I don't expect that anything here won't turn into law, but it's just worth being aware of that. Okay, what we'll go through, as we said, there's not a huge amount of depth in today's presentation. We're going to go firstly a quick overview of the economy. I don't want to go too much because your eyes will glaze over. What was discussed, scrapped, kept, what's going to be done to improve workforce participation and ease up labour shortages, some expanding compliance measures. So what's happening to expand compliance? So the ATO trying to balance the budget by audits and things like that, as well as a few other measures that are relevant to small business owners. So first thing we wanted to go through is just a couple of key stats. As I said, I don't want to go through this for too long. The first thing we can see here is GDP and how it is in the current financial year and all the way up to 25-26. So GDP is what Australia produces as a whole. So what's our whole economy doing? So our whole economy is growing in real terms by about 3.25% a year at the moment. We're expecting that to slump in the 23-24 year to 1.5%, and then picking up to that 2.2 to 2.5% in the couple of years following. What this means, everyone's talking about recession and everything else at the moment. The term for a recession is 2 consecutive quarters of negative GDP. It doesn't appear that the government is forecasting a recession for us at the moment. Once we go through these numbers, it may not be completely in our government's hands to monitor this, but at the moment, it's not expected that we are going to fall into recession. The next one, inflation, the word on everybody's lips. They're expecting inflation on an annualized basis this year to be 5.75%. This is going to peak, first of all, in the December quarter at about 7.75. It's gone up each quarter from between March, June and September so far. So the fact that they're annualizing it at 5.75% means there's going to be some sharp decreases in inflation in that first half of 2023. Wage growth, we can see, is 3.75% for the next 2 years, going down to 3.25% after that. What this means is wage growth isn't really real wage growth. It's not, even though you're getting more money in your pocket, it's not really the spending power that you do want. It won't be until pretty much the 2023-2024 year when the inflation actually goes beyond, so when the wage growth goes beyond the inflation. Unemployment, we're expecting to raise marginally. This is still historically low, but it is still a raise in unemployment. As we sort of said before, there's not a lot that the government can really do with these figures, and this is almost like they're their wishful scenario. Anything that sort of happens globally can affect these numbers. This could be, financial issues in China or Europe, the war with Russia and Ukraine, which is killing inflation at the moment, and especially, energy prices, which are contributing a lot to inflation, as well as, potentially COVID outbreaks. So this budget is low spending. They don't want to stoke inflation, but they also want to try and support the economy, but also to balance the budget after huge amounts of COVID spending that have, in effect, COVID spending that have basically needs to be repaid. There's a huge deficit there. And then we'll just jump on to the next slide. So what we're going to go through now is what wasn't discussed in the budget. First of all, what wasn't discussed is stage 3 tax cuts. There's been a lot of talk from mainly the Greens and mainly the Greens really to scrap stage 3 tax cuts. They're not sort of sustainable. I'm not going to go into the politics of it, but that hasn't been announced at the moment. Realistically, there will be another federal budget in May, and that's still a good 12 months before these cuts are due to come in. So just because we haven't heard that they're scrapped, there is still a chance for the government to change them. But if we don't hear anything, the assumption is that they are going ahead because they have been previously legislated. The Lamido extension. So this is was the $1,080 and now the $1,500 that's been added to everyone's tax return for taxpayers earning under $126,000 a year. This expired on 30th of June 2022. So for those of you completing your tax returns at the moment, and you're eligible, you are getting the Lamido as part of your return. However, from this financial year onwards, this doesn't look like it has been extended. Now, this isn't necessarily Labor doing something and scrapping anything away. It was never intended to be extended. The stage 1 and 2 tax cuts that have already been implemented sort of do make up for this. It's almost been double dipped for a couple of years, and that was done to help out during COVID times. The next thing that wasn't discussed was the domestic violence 10 days annual leave that will be eligible for all employees. The fact that it wasn't discussed isn't a problem. It's going through Parliament at the moment. It will pass, and this will come in. I believe there was a bit of spending with Fair Work and everything to educate employers on this, but the fact that we haven't heard anything is a no news, good news scenario. The extension of the instant asset write-off. Now, this is a big one for small business clients. In effect, if we don't hear that this gets extended in May, what's going to happen is that on 1 July next year, any asset that you buy that is over $1,000 will need to be depreciated over a number of years. So what this means is that there's no such thing anymore of buying a $30,000 piece of equipment and having that tax deduction in year 1 and getting the large cash flow benefit and saving. It hasn't been $1,000 for quite a while. It does keep getting kicked along the road. We'll see what happens in May, whether or not this does get extended. If it doesn't, it's going to be on the back of inflationary pressures. However, if we do see that inflation does sort of subside, I do really expect that this will get announced in some form. It may not be as generous as what it was, but it might be capped at $30,000 or $50,000 or something along that. The other thing that wasn't announced is that an extension to the loss carryback measure. This was a measure that was brought in during COVID times to allow businesses to claim losses that they were making due to shutdowns and through COVID against prior profits. So instead of carrying the loss forward and getting a benefit down the track, what was going to happen is that the loss was basically going to be taken back and you could get a refund of tax that you've already paid. Fuel excise. Now, this is what was announced in the last budget, which we got 6 months of fuel that was not, of a reduction in fuel prices. This was 22 cents per litre. It brought prices down for a little while at the Bowser. This ended at the end of September, and we've seen sort of the prices go up. There was no extension of this, nor was it ever expected, so it's not really a surprise there. Now, what was delayed is the next thing. Now, most of this is administrative and TPAR reporting. So what TPAR reporting is where bigger businesses pretty much report to their to the ATO what they've paid their contractors and everything throughout the year. First of all, it's Big Brother watching. That's a big part of it, and making sure that there isn't really the lost revenue from taxation. And with that, it's in the industry at the moment for cleaning and construction and a lot of these high risk sort of industries, and it's being brought into the sharing economy. So Airbnb and Uber style businesses, this is short-term accommodation and ride sharing. This was going to be brought in on the 1st of July 2022. This has been bounced back to 1st of July next year, 2023. The food delivery and task-based businesses, this is your Airtasker, your Uber Eats and those style businesses. This has been delayed another year again from 2023 just across to 2024. Nothing to really be aware of, but if you are in those industries or you do employ in those industries, it's just one less administrative burden that you have to worry about for a little while longer. Now, what was scrapped? So this is previously announced Liberal measures that the Labor has said, no, we're not going to go through this. So they hadn't already passed Parliament and there's no intention for them to. First was the 10K cash limit for business payments. So this was the outlawing of being able to pay a business anything more than 10K in cash. So now that this has been scrapped, there's no issue in paying businesses cash anymore, which is really weird, which you'll see on the compliance section a little bit later. And then the 3-year SMSF audits. So this was where if you were a good complying trustee of a self-managed super fund, rather than having to get your fund audited every 12 months, it was going to be extended to every 3 years to ease up on compliance. This has been scrapped, and it's probably not a bad thing considering some issues that are rife in the SMSF industry. Now, what was kept? So there's a couple of things that have just passed in consultation papers last month, and we do expect to be enacted this year. So these, once again, were Liberal measures that are still underway. The first one was the training 120% deductions. So what this is if you're spending with any registered training organisation, so a proper training provider, any spending that you do with them on eligible courses, you can claim 120% back up to 30 June 2024, so the end of the next financial year. This is just to improve, obviously, skills in the economy and making sure we've got a workforce that can do what we need it to do. Then the other one was the technology boost. Now, this one expires on the 30th of June next year, which is the current financial year. This is 120% deductions, capped at 100K, to support digital adoption and cloud subscriptions. So, businesses have done pretty well with this over COVID, but any other things that businesses want to do to sort of make themselves more mobile friendly and using more tech, there is a bit of a sweetener in doing this. Now, both of these expenditures, if they do get approved, and we do expect they will actually be eligible for expenditure from the 1st of April or very, very late March this year. So including pretty much the last quarter of the current financial year. You don't need to worry about amending tax returns or anything. When this does pass, it'll all be claimed in the current financial year's tax return, so the 2023 return. And it's also worth noting these measures are only for businesses that have got group turnover of under $50 million. Now, the paid parental leave, this was a big part one of improving the workforce participation. So as we know, paid parental leave was introduced quite a few years ago. It's been 18 weeks pretty much ever since. The mum could get that, and then the dad could get the 2 weeks dad and partner pay. What they've done now is overhauled this to have, it's sliding scale, but starting from 1st of July next year, it'll go from the 18 weeks to 20 weeks, and it will increase by 2 weeks every year to hit 26 weeks or 6 months by the 1st of July 2026, so in a couple of years' time. So by extending it out from pretty much 18 weeks to 26 weeks, this is aimed to keep mums and parents basically in the workforce, and to keep in contact with the employer, and to be able to come back in when those early childhood sort of years are over. Now, the beauty of this new system is that they've increased the income cap. It's been $150,000 since the date of inception, and that was based on the person claiming's own income. This is now going to be a $350,000 cap combined, so mother and father. Now, the great thing about this big cap that we have here is that if you've got a high income earner, the mum might be earning a bit more than the 150. As long as the combined family income is low, they do get access to all of this. Now, with this as well, it's been extended out for dads. So far, dads and partners could only get that 2 weeks leave at the minimum wage rate. Now, with this extension, there is going to be different portions part will be that mum has to take it and it's either use it or lose it. Part will be for dad that he can take it, use it or lose it. And then part will be sort of a combined where they can sort of pool and share depending on who wants or who's more able to take those care responsibilities. For single parents, they will be eligible for the whole amount, so they don't lose anything on that. Now, once paid parental leave is over, the next thing that has to happen is there needs to be some childcare for the kids. So this has actually increased as well. So at the moment, the childcare benefit caps out at 85%. This is going up to 90%, and that'll be eligible for families earning under $80,000 a year. This tapers down by 1% for every $5,000 earned, basically meaning that if you earn over $350,000 as a family, that there's nothing else that can be claimed. So this is aimed just to keep making sure that parents of young kids are being engaged in the workforce and then coming back in and being able to help with skills as soon as they can. The other things that have been announced is a migration cap has been lifted to 195,000 up from 160. And I dare say this has been a lot lower in recent years with border closures and COVID. But by bringing in 195,000 more immigrants every year, this is going to help in bringing in the necessary skills that we need and ease up on labour shortages as well. And no doubt will help with them spending money, will help keep our economy flourishing a little bit and hopefully dodge that recession. TAFE and university places, the government's committing $1.4 billion, and part of that is to include 480,000 free TAFE places. This is going to be for sectors that really need it the most. So this is for teaching, nursing and engineering focused areas, and there will be some geographic areas where they are going to focus this as well. So the areas with the most need are getting the support they need. Now, we're going on to the bad side of the budget here, and the government trying to, I guess, make sure that everyone is paying their fair share of tax, and by doing that, increasing audit and surveillance. So now is probably a timely reminder to renew your audit insurance policy if you like, just because if you get audited, it doesn't necessarily mean you're doing a bad thing. It just means that the ATO wants to look and make sure that you're not. So you can still be audited even if everything's being done correctly. So really what the government is looking at here is increasing tax revenue to balance the budget. They're going to employ another 1,248 staff. They're going to repurpose other staff more into compliance activities, as well as investing in technology to data match and to spit out more automated audits. So $80 million is being spent over the next few years in personal tax and incorrect deductions alone. So this is more your salary and wage earners, your rental property holders. $80 million is being spent, and they're expecting to return $674 million over the next few years. So they basically want to get 8.4x on their investment. The cash and shadow economy. Now, this is funny. They're implementing $685 billion in compliance costs, yet they're allowing cash payments to businesses over 10 grand. Doesn't seem kind of logical, but I'd say if you're going to spend this level of money, you may as well have a law that supports you, but whatever. Out of that $685 million, they're expecting $2.1 billion in return over the next few years. That's a lot of zeros. So that's a 3x return on that. The next one is the international businesses and the pretty much the tax avoidance task force. Now, this isn't just multinationals, this is small businesses as well, but with a tax avoidance lens to the audit activity. They're spending 1.1 billion over the next few years to return 2.8. So it's about a 2.5 return on investment there after on that one. And last but not least, they're trying to get rid of dodgy accountants and tax agents. So that's $30 million that's being spent there, and they're expecting to return $81.9 million over the next few years. This is all aimed at keeping our tax system fair and as fair as it can be, and making sure that everyone is sort of paying the right amount. But whenever we do see budgets like this and economic times are tough, this is where the government goes to get more revenue, is tax. So audits will definitely be on the increase. We are seeing it. Just make sure that you do keep your documentation handy. The accountant in me comes out. Okay, other measures. So a couple of other measures that have been introduced is the downsizer contributions. So this is where if someone that's approaching retirement age decides to sell their home, they can, this age has been reduced from 60 to 55 years of age. If you've owned the home for 10 years, 300,000 per person. So if it's a couple, 600K can be put into super tax-free. This is aimed to get the money out of their own name into a low tax environment, and the aim of the government, they're not just being nice, they're just wanting to basically make sure you've got enough super to live in and that you're not going to be a drain on the pension system. Crypto being treated as an asset, not a currency. It is nice to have this clarification. It doesn't really change much in practice. It's always been treated as an asset, either a long-term capital gain or under the trading system. But El Salvador decided to I think, have Bitcoin as legal tender. So because of that, there needed to be clarification as whether or not, cryptocurrencies could be treated as a foreign currency, or whether or not it should be treated like an asset, so similar to a share. We're treating them basically as assets, so similar to shares. The only carve out of this is if a foreign government, or our government for that matter, introduces their own sort of token or currency. If that's the case, it will likely be treated as a currency. They've kept this a bit open, obviously, because it's a new area and times are changing. The other thing that's been announced is $62.6 million over 3 years, supporting and planning upgrades to improve energy efficiency and reduce emissions in businesses. Now, these grants, there's really no detail on them yet of what they include. It's just that it's $62 million over 3 years. It's not a huge amount of money. I dare say with, energy prices tipped to increase by 50% over the next 12 months, they're really just wanting to have something to say, yeah, we're doing something about this. And there it is. When more details come out, we'll let you know. Now, the next one, and this is the clickbaity headline that we've used in the EDM, is the tax-deductible Teslas. This is probably the only sort of spending thing that we can sort of see. Obviously, the government isn't introducing this to stimulate the economy. They're using it to move people onto, away from, I guess, fossil fuels and onto battery and hybrid vehicles. The vehicles are no doubt charged by coal at the moment. I can hear you saying, the investment in green energy, I'm sure, will come. But anyway, for the time being, we can get a nice new fast car and get a tax break for it. So the way that this is working is if you buy a car in your business, what happens is you can claim it, and then any private use that you have basically needs to either be paid back to the business, or you need to pay fringe benefits tax on it. To encourage spending on these types of vehicles, what the government is allowing is an FBT reduction on these energy efficient vehicles. So it doesn't have to just be a Tesla. I'm just using Tesla as the model. So in effect, what's happening is if you spend about $80,000, so the vehicle has to be below the luxury car tax threshold, which is about 85 grand. Now, if you buy a Tesla Model 3, you can go for the long range. You can even upgrade the color to red for an extra couple of grand, and it's still tax deductible. You'll come in a few $100 short of that limit. Now, based on that, what will happen is you buy it into the company, you can reduce your taxable income in year one by $64,000 and claim the GST back up to the luxury car limit, which is about another 5 grand that you can get back. So what that means is if you buy a car right up to that limit, you can get $22,000 as a cash benefit into your company in that very first year. Where the beauty comes in is the no FBT. So this means that if a car is there and it's basically doesn't have any business use, it's completely for private use, it's just your car, but it's owned by the company. Usually the employer has to pay FBT, and that's just to make sure that you're not getting a tax deductible benefit that you aren't entitled to because there's no nexus to your work. So by not having that, the employer saves $7.5 grand every year, and you don't need to keep a logbook, and you don't need to actually be able to justify it. So it's not a bad little way of getting a nice toy paid for by the business and supporting the move to electric in the process. There is a little bit of a sting in the tail with this, is even though that there is no FBT and there's great tax incentives for the company, the individual, so the employee that does get it, they won't have to pay any tax on it, but they do have, it is treated as a salary sacrifice. So what this means is the grossed up value, which is about $30,000, I won't get into the technicalities of how that's worked out, trust me, basically gets added onto your group certificate as adjusted taxable income. So you won't pay tax, but that 30 grand does affect you for means testing for certain things. So that could push you over the edge for private health cover if you don't have it, and Medicare surcharge. It might mean you have to pay will mean you're paying a higher level of HECS if you do have a HECS or a help debt. And things like the childcare benefit and the paid parental leave we were discussing earlier, this $30,000 will get added on, and that will be treated as if it was normal income for those purposes. So while there is no tax, for certain people there could be a cost. It's worth noting that these numbers are based on sort of spending out the whole limit. If you do buy a car that is considerably cheaper, then these numbers do scale. Worth keeping in mind on this still is not legislation. It was announced in July. The fact that it's in the budget means the government does expect for it to come through, but at this point it is not 100% there. Now, that was the main thing. There were a few questions that we did get sent to us, and we've got basically, first question is, with the cost of energy increasing, is it still worth buying a Tesla? Great question. Increases are basically increases in electricity are going to go up by about 50% over the next 12 months. Basically, if we go, let's use that Tesla Model 3 long range that we discussed in the previous example. It's got an 80 kilowatt battery. That costs roughly about $16 to fill up at the moment. It'll go up to about $24. You'll get 500-600 kilometers per charge based on that. So yeah, well, the amount as a percentage is better. It is still much more cost effective than fuel. The cash rate is still expected to rise by 0.75%. What does this mean for mortgage rates, and when will interest rates go down? First thing I want to sort of add to this is the 0.75 is what the government thinks it'll go up. Economists and big banks actually do expect it to go up more. But to answer this sort of question is, that where they are at the moment, a lot of borrowers are paying that 4.75% in interest, and this means that 0.75 increase will bring it up to 5.5. On a $500,000 mortgage, basically that's going to go put repayments up to from $2,600 at the moment up to about $2,800 with that increase. Now, it's worth keeping in mind that $200 doesn't sound like an absolute massive amount, but back in April, before these interest rate rises, the monthly repayment was $1,900. So it's about a $700 increase, which is really going to be hurting the family budget. When will they go back down? Realistically, once inflation sort of subsides and it's within the sort of the 2 to 3% mark that the RBA is comfortable with, they will start reducing their interest rates. We may start seeing interest rates reduce sooner, depending on global sort of issues and pressures. So if there's global issues and pressures there, so potentially inflation in the Ukraine, so due to war in Ukraine, or the Europe financial issues that are happening, if that brings the cost of external borrowing up, then we can't really control that. So the RBA will use their only lever that they've got and reduce sort of the interest rate to, I guess, counteract for that. In regard to the paid parental leave scheme, are there rules around when each parent can take leave? Yeah, there is. It's actually quite flexible. So families can access up to 26 weeks of leave pretty much from 2026. So it's at 18 at the moment, going up on the 1st of July every year by 2 weeks until we get it. Part will be use it or lose it. Part of it will be for mum, part of it will be for dad. We've already sort of discussed this part, but there is one good part where part of the blocks can be taken as little as a day. So if you're wanting to get to work sooner, you can also take those requirements, with something that you agree with your employer, gets you back into the industry, and everything will be smoother. And the other good thing as well is both parents can take leave at the same time. So, during those really hard sort of, first 4 to 6 weeks of a baby when they're, completely fresh, mum and dad can take the time off at the same time and, build up that bond, which is really great. That's probably an answer to that. As a rural allied health worker, will there be tax concessions or grant incentives to assist retention? There's not a huge amount of detail on it. There was a rebuilding healthcare workforce package announced of $185 million. This is aimed to support doctors, nurses, and allied health in regional areas. At this stage, there's not really any detail of how it will help with, retention, or whether or not it's going to be for new staff, I guess sort of time will tell. Now, in regard to, and sorry about that one, it's not really a great answer. I just don't really have much detail on that to provide. In regard to the proposed stage 3 tax cuts, how much is the average Australian going to save? So average earnings, so we're not talking median here, we're talking average. So taking into account people earning $2 million a year and lower is $95,000 a year. People on that wage will save around $1,260. This is in addition to the $407 that was delivered in the stage 2 tax cuts that have already came. Higher income earners, so let's say $180,000, will save about $6,000 if this comes in, and people earning $200,000, because the upper rate will increase as part of stage 3, will save about $9,000. That's pretty much there. Will they come in or will they be changed? It's something that we're yet to know at this stage. Yep, and it does not appear that we can see any other questions there. If there are any, someone from our team will reply to you directly. Thank you very much for your time. Have a great day.